Hello, and welcome to today's Environment and Energy Leader webinar titled Energy Outlook Update, Wholesale Market Surge Implications, sponsored by NG Impact. My name is Jessica Hunt, and I'm the Director of Live Events for E&E Leader. First and foremost, thank you to all attendees who are joining us today, and thank you to those who will be watching this on demand. If you happen to have any technical issues during today's event, please use the troubleshooting widget at the bottom of your console. If you are still having issues after performing those steps, please feel free to send a message to me using the Q&A widget, which is open already on your screen for you. Attendees do have the ability to chat with each other during today's event. To utilize the attendee chat feature, you may have to double-click on enter your message. So please say hello and let us know where you are from. The team at NG Impact will be providing resources to all attendees by tomorrow morning. All you have to do to access these resources is jump back into the platform and they will be available for you. We will be having a few poll questions during the event today. If for some reason your screen does not advance after you answer the poll question, please just refresh your page. And as always, we are going to be having a Q&A session at the end of the presentation. So please submit questions for our presenters over the next 40 to 45 minutes or so. And without further ado, I would love to introduce today's speakers. We have two experts from NG Impact with us. We have Jonathan Lee and Brian Dooley. And at this point, I'm going to turn the presentation over to them, and I hope everybody enjoys it. Thank you in advance.
All right, thanks, Jess. Appreciate the intro, and thanks to Environment and Energy Leader for hosting us today. We're excited to be here. Let's see, looks like we went over that so far, but so today, I know most of you know the energy markets are running really hot right now, so we want to leave you with some insights into what's driving the market, what's behind the energy market surge. There's several different components at play. We also want to give you an outlook of what to look for the second half of the year and maybe a little bit beyond. How long will these high prices be here? And then I'm also joined here by my colleague Brian Dooley, and he's going to talk about some creative solutions. The renewables market is not immune to the price increases that we've seen, and so he's going to touch on some creative solutions to help you deliver on commitments you've made in the past and not just put some of those to the wayside. So with that, we'll start with the energy market outlook portion. And first we have just a poll here just to get a gauge of where people think the market is trading at. So the first poll question is the NYMEX natural gas is X% higher than last year. Are we at 50% higher? Are we at 150%? Or are we at 250%? So I'll just give you a few seconds to click your answer, and then we'll discuss those results and dive right in. All right, looks like it's filling up. It depends on at what point you peg the market. We've had so much volatility that it's been a wild ride so far. All right, let's move on and see where we're at. So we got 25% saying that we're about 50% higher, and the majority saying we're at about 150% higher. And I will say, as of today, the market is up another 50 cents, but it did claw back. So today, if you're looking at the 12-month strip for natural gas, we're sitting at 72% higher year over year. Yesterday was at 58% higher. So it's kind of in that in-between zone. If you were to look in June, beginning of June, we were at 169% higher. So there's all kinds of range there, but a lot of you pegged it pretty close. All right, so this first slide kind of got a gauge of where we're at with the NYMEX natural gas curve. And you can see this is a historical look back to 2001 to put some perspective behind where we are in the market at this point. You can see how over the last 10 years, really since the shale gas revolution, where production domestically really started to pick up, we've been in a downtrend for a long period of time with some blips here and there, polar vortex of 2014. But really, we had some supply glut where domestic gas was not being shipped overseas like it is today. So that's a new dynamic. And then in 2020, we hit a more than 20-year low. We had a very mild winter, the start of the COVID pandemic, which zapped demand. And then since then, we've been climbing higher as economic activity has picked up. We've had LNG resources go overseas and started to see some more volatility. And then at the start of this year, really saw it ramp up to the highest level since 2008. And when the meeting invite went out, we were at that level, and you can see how quickly we've retreated, but we're pushing back towards that $6 level. So I've been in the industry for 13 years, and I was at the tail end of the commodity bubble and collapse. So this is actually an environment where I haven't been in quite yet, and so we're seeing some of those new dynamics come into play, and it really is making it challenging for customers to layer in third-party supply contracts, especially with the volatility. And so we want to talk about maybe some of those strategies that you can implement to deal with this new price environment. So here's a look at the forward curve. That's just a look from August 2022 contract, which is the prompt month, the nearest futures contract that you can purchase, all the way out to December 2025. You can see it's a 2-year trading range on that gray scale. Last month, we were at the top of that scale, and just over a month, we've declined almost $3 or so, $2 for the near term. A little less on the outer years, but currently the market is backwardated, which means the near-term contract months are trading higher than farther out. And so when you're looking at a contract, it's more expensive to buy those near-term months and a little cheaper to buy those outer months. So if you're having a hard time meeting your budget, maybe look to extend a contract. That's one idea. Purchase multiple years at a time to bring down that average cost, or maybe layer in some percent purchases to have either a risk exposure eliminated off the table, and look at maybe having some of those months ride index to see if prices will continue to come down. But we did see that drop really take place last month. There was a unexpected explosion at the Freeport LNG export facility. Not any damage is not good, but it actually worked out to the U.S. domestic market's favor. Not so much for European and Asian markets. But essentially what that did is it locked in about 2 BCF per day that was heading overseas, and has kept that domestically. So that loosened the tight supply and demand balance. And we'll discuss some of those in the upcoming slides, but it really helped the market come back, reduce some concern over upcoming winter. But the volatility is still going to be there. We still have a lot of summer left. Right now, there's a big heat ridge building in the central U.S. that's causing a lot of increasing power sector demand. And so that's reducing the amount of gas that will go into storage for winter. So we still have a lot of that in front of us. So there's still that volatility, which makes it extremely difficult. Okay. So there's several factors driving the market, but one of the biggest ones right now is the view of natural gas in storage. And we're currently running at a deficit to the 5-year average and to last year. The chart on your left right there shows weekly additions to underground storage. And the green bar is current year, the shaded is the 5-year average, and the dotted line is last year. So the big takeaway on that is we're running right at or just below the 5-year average. So we're with the deficit to the 5-year average currently at 12.2%. There needs to be work done to bring that to that 5-year average ahead of this upcoming winter. If we trace that forward or forecast, if we're running right at the 5-year average, we're looking at pre-winter levels right before we start withdrawing natural gas from storage, right around 3,300 BCF. Put that in perspective, that's the lowest since 2018. And what that does is it causes some underlying bullish sentiment in the market, reduces the ability for prices to come down, and actually accelerates the potential for the upside. So really what we need to see over the next several weeks is stronger weekly injections. It does help with that Freeport outage, but with strong power sector demand, that's offsetting some of that gas that can be put into underground storage. And then another component that is key to this is natural gas production, the pace of production. Right now, we're currently sitting right around 96 BCF per day. That is not strong enough to meet the current demand that's out there and refill storage. So one of the highlight points in the invite was, why aren't producers increasing that would reflect a price environment? If we were to look back, 4 years and gas was sub $3 and we moved to a $4 handle, producers would be jumping all over that. Right now, we're not seeing that to an extent, and there's a couple reasons why. In 2016 and 2020, those were multi-year lows because we had so much natural gas production and not demand. So the scale was tilted to the supply side, which caused prices to crater. So producers have lived through 2 of those events in the last really just 7 years. And so from a investment standpoint, they have incurred a lot of debt. They haven't had the returns to their investors that maybe would be desirable and increase future investment. And so most of the producers publicly have said, okay, we're going to stick to a very strict capital expenditure, production pace, regardless of high or low price environment. So currently they're paying off a lot of debt. They're increasing their dividends to their investors. They're also not immune to other challenges that we've seen in the economy. So labor shortages, supply chain disruptions, getting materials to create new rigs for new equipment to bring the gas out. All that kind of stuff working to slow the increase in production growth. We probably need to, EIA is estimating that second half of 2022, production will rise to 97.9 BCF per day. That'd be about a 2 BCF per day increase. And then in next year, 2023, estimating about 103. So they are estimating that although it's been slow growth, it will start to pick up and start to balance the supply and demand equation. But currently, it's not enough with what we're seeing on the demand side. And probably one of the biggest changes that we've seen over the last year and a half, 2 years, is the increase in exports to global markets via liquefied natural gas. These facilities have been in the works for the past 6-7 years or a little bit longer. The first one was Sabine Pass along the Gulf Coast, which came into effect a few years ago. But since then, we've had several other facilities come online to where now natural gas export capacity is sitting just below 14 BCF per day. Put that in perspective, that'd make it the 4th largest demand source behind industrial sector demand, residential commercial heating demand, and then also power sector demand, which is currently the largest source. The chart there on the left shows the destinations of where those LNG cargoes have gone. Right now, it represents about 12% of overall consumption when we look at 2021. But the major markets right now are, in fact, Europe, and that's grown since the start of 2021 quite a bit. So as LNG exports have increased, Europe, we know what's going on with the war in Ukraine, between Ukraine and Russia, has had a big impact on Europe's energy security. They currently get about 40% of their natural gas imports from Russia via pipelines through Ukraine, Nord Stream 1, which is currently just went offline for maintenance. But now they're saying there might be an extended offline because they need a compressor that is currently sitting in Canada, and that could be delayed to ship back to complete the maintenance on that. So there's a lot of geopolitical issues going on with Europe and their energy security of natural gas. So they've called on the U.S. to help them with refilling their stores. They have to be at 90% of stores before November. They're currently sitting right around 55%, 56%. So a lot of those cargoes have gone that were going to Asia, say Korea or Japan, have been diverted to Europe. Also, the Freeport LNG was almost exclusively shipping to Europe. So with that offline, see the map on the right, or the chart on the right shows U.S. prices, Henry Hub spot in the blue line. So, and then those other markers, you have the UK National Balancing Point, the Dutch TTF, and then also the JKM, which is the Japan-Korea marker prompt month. Now, if we thought we had it hard here for energy prices, and we do, our friends in Europe and in Asia have it much worse. You can see the recent spike in prices. That was due to the Freeport outage. And so with Europe looking for U.S. supplies, 2 BCF per day now not being sent over there, and Freeport is going to be out for, I think they say January 2023, so another 6 months. So that puts it into winter time frame where they won't be receiving that gas. And then with the potential for Nord Stream 1 to not come online, that's caused prices in Europe to really push to the upside. So they're sitting right around $40 USD per MMBTU, and we're sitting right around 650, almost 7. So there's a big disparity. And what that does is, before LNG exports, the U.S. gas market was really insulated. There wasn't really geopolitical events that would impact natural gas price movement, unlike crude oil, which has kind of a global feel to it. So if anything happens supply-wise or demand-wise, it affects U.S. crude prices. It didn't happen to that with U.S. LNG or with U.S. natural gas, but now it is. So that volatility that is in those Asian, European markets, some of that sentiment and fear is seeping into the U.S. markets. That's why we saw a lot of volatility last October. That's why we're seeing a lot of volatility now. That's part of the reason, is some of that speculation, some of that fear is working its way into the U.S. gas markets. And then with power sector demand being, or gas-fired generation being the major source of electric fuel supply, that's now seeping into our U.S. Wholesale electric markets. So that's having an impact not just on the gas side, but also the electric side. And then with the Freeport outage, that tightened the LNG export opportunities. So we actually saw New England prices jump in response to that as well, since they do import LNG during those tight winter months when commercial, residential demand for gas, heating is high, and also power sector demand is high. So that's going to put some pressure on those New England markets heading into winter as well. And then moving more specifically towards the wholesale electric markets. So you have all that bullish support in the gas markets. That certainly works its way into the electric markets. Most of those wholesale markets are running above 90% correlation to price movement in the natural gas market. And so that certainly affects how we've seen those prices move. But there's also grid reliability concerns that are adding some premium to the forward market. If we look at MISO, before summer, they issued a ready assessment, and they're saying they're about 3,200 megawatts less capacity compared to the summer of last year. There's also a key transmission line that runs from the north to the south of MISO that was knocked offline from a tornado last year. It's in process of being repaired. Last I checked, it hadn't come back online. But that limits the ability to transfer generation from the north and south of the MISO territory, which then creates reliability concerns. So they're saying that this summer in an extreme heat situation, they might not have enough generation to meet the load that might come on the grid. They're not alone. ERCOT, which is in the Texas market, covers a large portion of Texas. They're in an extreme drought right now throughout the Texas market. So when you have dry soil temperatures and you get hot temperatures, that can prolong the heat events and then also increase demand. So right now, they're actually having their hottest summer since 2011, or even higher than that. They also have a lot of new demand that has come into that market. It's a big market for crypto mining facilities, which can run 24 hours a day. So bringing a lot of load there. A lot of residents, businesses increasing the demand in that market. And so if you have those prolonged heat events, that's going to increase demand. And they're saying that they're at some risk for potential blackouts, especially with the current heat that they're seeing at the moment. When we move out west, looking at California, they're also in a widespread drought, as is much of the western U.S., but they didn't have a great snowpack year. In fact, they were, I think they're running at the lowest snowpack level to exit last winter since 2015. So what that does is it weakens hydro output later in the year when you have less ability to produce hydropower with lower reservoirs and so forth. So that's going to put strain on that market, especially in those early evening hours when solar power declines, and there's a need to replace that demand with quick start gas plants or imports from other Western markets. But in a widespread heat event, those markets in the West, Arizona, Nevada, Colorado, they're going to need that supply of that generation to stay locally, and so they won't have the ability to import it or transmit it to California. So that could create some issues there. Luckily, California hasn't had too hot of a summer so far, but it's looking like that could change, especially in Southern California. The other markets, we look at PJM, which is kind of a footprint of the Mid-Atlantic to parts of the Midwest, and then New York ISO, which is New York. They seem to have sufficient generation, but in any kind of extreme heat event, that could cause some issues, or at least increase the volatility in that market. Another component just overall is there's limited coal switching. So if gas prices are high, generally you'll switch to a cheaper fuel source, which would potentially be coal. But there's limited supply of that because of widespread coal plant retirements, and also coal prices are very expensive at the moment as well. So grid reliability issues, just kind of sum it up, are impacting a lot of markets. So that's adding uncertainty and premium into the forward markets. And a big part of that is with those reliability concerns is we've had more events that have strained our energy infrastructure. So this is a look at extreme weather, which is becoming more common. It's more costly because it's creating more damage and more deadly. So it's over the last 22 years, it shows in $1 billion in losses and the number of events during that time frame. So the green bar shows events. So you can see that has climbed since 2000. You look at Hurricane Laura, Western wildfires of 2020. Last year you had Hurricane Ida, Winter Storm Uri, which cost billions of dollars, and widespread blackouts in Texas, unfortunately loss of life. during that event. So we're seeing those become more frequent, and so that's creating more strain on the grid as well as we move forward. And then this is just a look at the summer. You see those where that hotter temperatures are forecast. A bulk of it is in that south central area, which has been hot since May, really. These predictions were created in kind of the June-May timeframe, and they've really played out the way that they were forecast. Above normal temperatures are expected really throughout the country, but maybe a little bit less, a little bit more precipitation, wetter conditions in the eastern half of the country, hotter, drier conditions with less precipitation in that central U.S. western region, which is where a lot of those grid reliability concerns are have been issued. All right, so we want to go to another poll question. We talked about really what's fueling the energy market at this moment, but we really want to understand how is that impacting your company's budget. I know it's painful and it's very difficult. So we wanted to just kind of get a gauge of how is energy inflation affecting your company's budget? Are you struggling to stay on budget and likely to go over? Are your current strategy or energy mix is helping you to maintain balance despite these rising costs? Or you have some long-term contracts in play that are helping you stay on course. So we'll just give you about 30 seconds to enter your answer there. I know, Brian. It's not just the traditional brown power. We're seeing it in the renewables market too. I mean,
yeah, it's really common. There's a bunch of different factors driving that as well, John. But it is not uncommon to see some of the renewable prices track with their traditional brown power prices because renewable developers are trying to make sure that they can be within sort of spitting distance of traditional generation, so their price point doesn't look wildly different.
Yeah. All right, looks like we have a good amount submitted. Let's take a look. So actually pretty balanced, but definitely more to struggling to stay on budget, likely to go over, and then some with some longer term contracts that are helping companies stay on course. And that's really the challenge that we've seen at NG Impact with our, as we're looking at to help our clients is if you've had longer term contracts, that may be issued in 2020 where there was 20-year low, you're probably doing okay. Hindsight's always 2020 though, right? So it's what can you do now in the environment that you're at? Really, there's a couple different ways to look at it. A big one is probably changing mindset from savings, which which showed that chart earlier, which from 2011 to 2020 there was more or less just downward trend in the market. So shifting from savings to maybe finding value. So looking at that forward or futures market, and find that those months, those outer years, or short-term pullbacks to find value in the forward market to remove some of that exposure, and then also maybe look at different percentage of index that you take some exposure off the table, like a dollar cost averaging, and then look for those pullbacks in the market to implement a strategy or be able to act quickly. So you have to have a strategy in place, and that's a big piece of it. So we've seen that clients maybe need to shift their strategy and take another look at things to help with these over budget situations. We talked a lot about the natural gas market, but like I mentioned, it does impact the wholesale electric markets. So here's a chart showing different regional ISOs. ERCOT, which is Texas, it's the average of those 4 main zones. New York ISO Zone J, which is New York City. PJM Western Hub, ISO New England, MISO, and then PG&E, which is California. you can see the ramp up really does coincide with the natural gas market. But then we've seen that volatility in that September through November timeframe, and then volatility most recently. So we have seen a decent pullback in some markets. ISO New England, like I mentioned with that Freeport outage, actually responded inversely to the other markets. But what's driving wholesale prices are higher fuel costs for power generation. It's not just natural gas, it's coal, like I mentioned, and other sources, lower hydro. Those grid reliability concerns, adding a layer of premium. We got the hot summer forecasted, which would increase demand, widespread drought, which is creating potential for longer, prolonged heat waves with drier soil temperatures. We talked about limited coal to gas or gas to coal switching, and then also supply chains being stressed. So it's a look at, it's not just gas, wholesale prices are pushing higher as well. But a lot of what fuels wholesale electric prices is what the fundamentals of natural gas. So here's a look at the different electric calendar strips, wholesale. We're starting from 2023 calendar year, looking through 2025 for those different regions. And again, wholesale, these markets are also backwardated, meaning that prices are more expensive near term. That's just the belief that the market's going to be tighter near term and maybe loosen the farther you go out as things start to normalize. But 2023 is higher than 2024 and 2025. So maybe look for some of that value, like I mentioned, in those outer years to reduce that exposure in case conditions do stay the same and that increased premium just rolls to the next year, which we've seen the last couple of years. And then also, so what to expect? I want to touch on that. What to expect for the next, second half of the year? Really, what we're looking at is natural gas storage replenishment. Can we get above the or closer to the 5-year average, which is right around 3650 BCF? Can we close that gap? That's a big one. Is production going to increase like the EIA anticipates to help close that gap? Or are we in for a hot summer, weaker storage refill, and then that puts pressure in those, especially those winter months? So production and weather are going to be key indicators to watch, as weather can be very difficult and hard to predict, but that will be a main driver, especially in the summer. And then when we get into those September, October, November, if we can have milder temperatures, strong refill, that might help reduce some of the volatility in the markets as well. But those will be important months for the market to balance. So with that, I don't want to go over too much. I want to pass it off to you, Brian, and give you a chance to go over your material.
Yeah, thanks, John. There was tons of really good information in there, and definitely seeing some different market dynamics in your space than we've seen for a long time. That's translating over into the renewable energy sector for a number of different reasons. There's some other drivers here, so we're going to talk a little bit about what's going on that's really shaping the market. I think people are well aware, companies are well aware that more and more organizations are setting science-based targets or other targets. The level of activity and the total commitment is really exponentially increasing here. I think for a few reasons we'll see as we work through these additional content here. The commitments and that commitment level is huge, very public, new actors driving some of that. And therefore, what we're seeing is, this heightened demand for renewable energy solutions that is meeting a marketplace where, we continue to see growth in renewable asset development, but not at a pace right now that is equal to meeting the commitments that many of these companies have made. And so we're going to see a sort of a pinch here in terms of folks trying to plan for renewable energy sourcing in the first half of this decade, and looking for who's going to be bringing online consistently the capacity to meet those needs. So these science-based targets, this is an amazing driver of the market. While near term maybe a little painful, as a renewable energy professional, I'm excited to see that there's more companies making these commitments and signaling to the market we want more renewable energy. However, that comes at a time when renewable costs are increasing as well. So PPA costs are one indicator, and have been increasing significantly here since the beginning of January 2021. There was some, with COVID, there was definitely some challenges for continued and successful development of new projects based on supply chain issues and slowdowns and everything like that. That's part of it. But you can see here on the table on the left, right, there's also the hard costs for many of the components used for different renewable energy assets has been increasing, both because of supply chain issues and some in particular some of the tariffs related to the solar industry. In the middle chart here, you can see interconnection challenges are significantly increasing. It's never been super simple to connect. There are some places that are better than others, but as you can see, there's a lot in the queue, and they're trying to in this case PJM is trying to keep up with all of the requests. Not just PJM, we're seeing in, for example, in MISO, looking at some relatively recent data, there were about 65% of the interconnection requests that were withdrawn or simply exited. That's a huge percentage. It's a gigantic challenge for those of us trying to find renewable energy solutions, either for our companies or for our clients, because the expected generation and the discussions we're having with development partners today are increasingly finding delays and or projects that don't move forward. And then in this last chart here, you'll see that with this recent spike in 2021 of RECs to about $7.15, the dynamic in the market is changing for using unbundled RECs as a low cost, easy to transact type of product. Companies that we're regularly seeing, as you can see, toward 2020, but even before 2020, for a long period there, the value of unbundled RECs was in the $1 range, and so folks could budget, plan for, and meet a fair amount of their renewable and sustainability goals through that product. The volatility alone is causing many people to have to revisit, hey, is this something we can sustain? We have seen a reduction, and then a bit further, this graph here is stopping at January. We have seen some improved near-term pricing, but with the high level of corporate commitments and the increase in demand, we don't expect to see low levels of unbundled renewable RECs in that $1 range again anytime soon. And this is one that I think is also, it may seem somewhat indirect, but it is really fascinating and a really important driver. So in the past, many organizations taking on renewable goals, sustainability goals, were doing so as corporate stewards for the benefit of their perceived brand for their customers and clients. But we've had like a significant shift in the investment community. And you can see some of these here as well. In particular, one that was a real catalyst was the CEO of BlackRock coming out and in an annual statement indicating that sustainability was going to be something they would measure relative to a company's valuation and therefore relative to their access to capital, and how to think about companies from an investment standpoint. There for a long time here, there was not strong data or research on the correlation between sustainable practices within a business and overall profitability and efficiency. I'm thankful to say that I have seen today some reports, in particular one out of state of New York, the university there, that found this strong correlation. And I think the investment community is recognizing sustainability, the big umbrella sustainability really starts with looking at what are you using and how efficiently are you using it, and sort of clean up house. You don't want to source renewable energy or offsets or anything else that you don't have to if you can tighten your operations, and that's where a lot of that starts. We're also seeing, the Security and Exchange Commission has a proposal for additional disclosure on greenhouse gas emissions across a larger swath of the economy. That is a huge change as well. So these are really important indicators, if somewhat indirect. You may not see them on the company or client side, but they are driving a real change in the renewable energy markets. Okay, let's do another poll here. With increasing wholesale and renewable costs, which of the following actions are your company taking? And this is something really interesting we're seeing differently across different clients. So are you pausing to reevaluate? Are you reducing your activity? Are you pushing forward, or are some of you doubling down? So I'll give you a minute to put your answers in, but I can tell you it is a really different environment. As John mentioned before, asked me before, with low cost energy, renewable providers were really in a position where even if it's not an apples to apples comparison for traditional energy versus renewable. That's the way a lot of energy management departments, operating facilities had to look at it. They didn't have anything else. And so renewable developers were, working really hard to try to be in close proximity to those prices. That isn't the only reason, but that prices were low. There were some great some reductions in major system components for things. But point being is, as the market prices rise for wholesale and traditional energy, if these renewable projects were operating at very thin margins, which I know they were from my time working as a commercial developer, they're now allowed to sort of track against that wholesale market pricing increases, and quite honestly, protect their margins a bit more, which have traditionally been very low. Okay, so let's take a look. So pausing and reevaluating, we got a 30%, reducing 9.7, continuing on, we got 51, and doubling down 9%. So I think that 51%, 52% we're seeing here is reflective of more companies making commitments. It's reflective of those companies knowing that they're not in a position to wholesale, forego. We'll just pause on meeting those goals. I think what's interesting is it's causing more anxiety about how are we going to get there, what can we do, and so this question that we asked you was really, a lead in on, okay, what are some things to think about in terms of continuing to pursue strategies that may not be the highest cost premium. So there's a couple things we wanted to touch upon here. Community solar is expanding. It's I think a nice nexus of the utilities, the development world, and the client off-takers. appreciate the transactional structure. That subscription allows for offsite solar gardens to effectively credit you for the renewable energy. These can drive cost savings against your traditional energy expense because the programs are largely developed to provide credits against your utility expense based on the value of the solar coming from that garden. And it does support additionality in the markets that you're in. You'd have to have accounts there in order to participate. But as in all things with renewable, you have to think carefully about the marketing of it. Often the RECs are not provided. But those guaranteed savings from community solar can be used to acquire replacement RECs. And while that strategy for some in the past had felt like, hey, why am I sourcing renewable energy but not getting the RECs? The reality is the financial model allows for a new funding mechanism to purchase those RECs. And in a market where you can't easily access all the products in all the markets, that's something that I think people should look closely at, think about. I also think tax equity in the middle is really interesting here. Currently, the investment tax credit in the United States allows for an investor to offset tax liability at an attractive level. And then what we've seen is, while many companies don't feel like they're in the market for asset investment, in a challenging market or a rising cost market, if you have capital, the tax relief as well as the distributions from that investment vehicle can be used again to fund a different renewable strategy. And that's what we're hearing a lot of people looking for. And then in addition is credit insurance. There's a whole segment of the market that's struggled to access renewable energy where credit ratings did not meet certain thresholds. We're seeing former developers frustrated with that move into this space and start companies in which what they're doing is they're allowing for a reduction in the cost of a letter of credit that was prohibited in the past with an insurance product that's off balance sheet and brings down the total cost in order to allow folks to access the market. 1 second. Okay. I'm going to go a little quicker here, make sure we get to some Q&A. What I really wanted folks to see and understand about this is while the current programs, which were sort of vanguard or out earlier in the market, are largely subscribed, there are community solar programs in many states, and there's a number of states that are looking at the success of New York, Minnesota, Illinois, even most recently, and they have legislation and or are moving towards these programs. It's an important thing to keep an eye on because, again, it's a savings mechanism that can help support your renewable goals, even if not directly. Real quick, as I mentioned, it's a guaranteed saving to change your operations or your facilities. There's flexibility to move your community solar subscription among accounts in the same utility territory. You really don't have any price risk. The programs establish a value for the community solar that the developer then delivers to the utility, and you work out a shared savings arrangement, essentially, that is fixed. And then this really is also a great way to participate in helping support additional generation. Your support, your enrollment ensures that third-party financing of many of the community solar projects can be achieved and the build-out continue. On the tax equity side, real quick, this is the one I wanted you guys to see. I think it illustrates really easily and simply what the value is. For indicative purposes here, what we've looked at is essentially an investment of $29 million. And this was for an actual project based on the project size. That generates $25 million in federal tax credits, a positive NPV, and in this case, the ROI is closer to 2.5%, because what we helped our client look at in this instance was, you see this annual cash flow distribution in the middle. We said, okay, take that and use that to fund other renewable energy purchases through RECs. So in addition to a strong tax relief mechanism where tax liability exists, you have a mechanism to fund a really interesting transaction. And while $29 million is shown here, you should sort of think of the lower end as of tax equity investment closer to 10 million. And then in terms of the credit support, what I really wanted to do too, folks, is to show you, and I bet it's a bit busy, I get it, but what we're finding is that, and what I've seen in my career is that when you need to provide a letter of credit on the buyer's side, you're typically looking at, $100,000 to $200,000 per megawatt. And that just destroys a lot of deals and a lot of potential value. In particular, our partners at Energetic Insurance have shared with us an example for the purposes of helping folks understand. I draw your attention to sort of the green portion in the middle here. In a letter of credit scenario only, you're looking at, in this example, we were looking at a $20 million letter of credit required. No credit insurance here coverage. Your total credit support is $20 million. And the 3-year credit support cost as a prorate value of that letter of credit is $2.4 million. Conversely, in a scenario where you utilizing this credit insurance, it brings that letter of credit face value down to $5 million. The credit insurance covers the remaining $15 million. You get a total credit support of $20 million, and it brings down your total 3-year cost to $1.3 million, or about 43% savings. So super interesting product. Great way to access the market if you're struggling to get good terms because of credit issues. I should say that in this scenario too, that credit insurance, typically the developer's project costs, and can be for a 3 and 5 year term, so that you have the opportunity, should your credit improved, to eliminate that additional cost for you. And so with that, sorry, do a little speeding through. Wait, I'll go back here. John, should we take a look at some of our Q&A? I want to try to make sure we had a little time for that.
Yeah, for sure. So one I saw real quick, and maybe you just touched on it, but why in some cases with community solar you can't access the RECs, and that is that typical of community solar, or is that?
It is pretty typical. I think about it as a sort of like a tri-party arrangement, right? Because oftentimes the community solar programs are supported by the utility, and as a way to democratize community solar, in this case, procurement options for smaller users, diverse users. But what they want to do then, in many cases, they roll those programs out to support their renewable portfolio standards, or their state renewable standards. So they are looking to retain the RECs. The developers typically don't have the utility expense and usage on their side, right, to monetize the value. So they enlist the aid of companies and organizations that are savings, and again, as a different funding mechanism for other RECs. Folks find that they don't like the rec replacement portion of it. Honestly, I think, there isn't enough renewable energy physically available and directly available in order to support all these companies' science-based targets. So engaging in these, but being open about the diversity of what you're doing as an effort to get to a place where you can source as much renewable energy as you really want is still a good message. It's still a good story.
Yeah.
So let me ask you this one, John. Given the recent increases in energy prices, you talked a little bit about it in terms of sort of the very near term. Do you think these increasing energy prices are here for a longer term? And if so, what might be driving that? Or is this a big product of what you showed us with the LNG going to Europe and some of the global geopolitical issues?
Yeah, I think that's a good question. I don't think necessarily the $8-9 gas or $130 power prices. I don't think that level is a long-term scenario, although it is maybe for the next 6 months. I think we really have to get through winter and see where the supply and demand balance is for that. But structurally, the market has changed over the last few years. With the introduction of LNG exports, the investment community shifting to more renewable space and not more towards that traditional fossil fuel. I think that's having an impact. Access to capital, like you mentioned, and then just the growth of natural gas demand and our infrastructure to move it around the country has been limited. And so I think we're running into a scenario where the supply and demand balance is probably going to stay pretty tight. And so we may or may not see, the $2-3 gas. The new normal might be, $4 to $5, maybe $6 of gas moving forward, which if you look historically, that's about the median, for where the market is at. I think it supports future growth and investment, but also doesn't promote too much.
Awesome. Thank you. Let's see what else we got here. Anything jumping out at you, John?
Yeah. How about this one? You kind of touched on it, but the ongoing, with high prices, power prices at the moment, what is that meaning for, CapEx? I think you touched on it with, the renewables market. Do you see that driving more CapEx to renewables? And then how does that translate to, companies that are investing in generation, transmission, or distribution? And I can follow up on the tail end of that too.
Yeah, so I would say there are a couple things in tension here. Some of the higher energy rates, to the extent that they allow for some relief in the renewable side on these very tight margins from the past that we're competing with very low cost energy, that will draw more development capital in. The information that I shared about BlackRock and other investment entities, that means that's a strong signal to the development community that more capital will be available. And they're seeing that science-based target increases and recognizing, hey, there's a big market out there. We want to be there, and we need to provide capital and provide it at a relatively, good interest rate cost. So on that side, you are seeing some strong signals. There do continue to be some supply chain issues and even ESG concerns about where solar panels are being created, and if they're particularly there's discussion about China and those tariffs. There are increasing commodity costs, and so I think you have that tension as well. I think those low energy wholesale market prices, as I mentioned before, as a signal of where renewable development pricing needed to be close to anybody's. Is that now that we're seeing those increases, real, true supply chain concerns, real true money to the developers. We're probably in a market where it's best to start to evaluate and try to find your renewable energy projects sooner rather than later. There may be some relief in the latter half of this decade, but I think we're going to see some higher prices for a while.
All right. I know we're at time, so maybe we just wrap things up. I know there's other questions in the chat. We'll get those and respond to you directly. So just wrapping up real quick. And on the tail end of that last question, just real quick, distribution companies are going to make their investments for their grid. They get their rate of return and pass it on to the consumer. But they're going to continue to invest in transmission and distribution, which is what we've seen. So that I don't think the CapEx is going to slow too much. They might be a little bit more wary to push for those if the supply side is still high though. But wrapping up, I think volatility is going to continue at least for the rest of the year with the hyper focus on that supply and demand balance. So likely no relief there until we get out of winter and potentially the balance is a little looser. And then that summer heat, that's that near-term focus, is really going to test the grid reliability. That could increase that volatility, in those markets that we discussed, especially as we're right at the doorstep of hot temperatures. And then lastly, go ahead, Brian.
Yeah, sorry, I was just going to say, you guys heard me say it many times here. There's increasing demand, sort of lagging supply. After a long period in which, I think purchasers had the opportunity to negotiate from strong position of leverage. We're definitely seeing this is a seller's market. But what I'm hoping you heard as well is be opportunistic and timely. You don't have to tackle your entire portfolio at once, nor do those transactions tend to be relatively quick. And even the most ambitious companies that say that they want to plan to do everything and decarbonize and become net zero, you have to start in a phased approach. So take a look at things that maybe in the past you've said, hey, I don't know how we feel about a community solar. We don't, the tax equity, we didn't think of ourselves as investors. These are different vehicles that are real and can help. So I think that's the takeaway is increasing demand and lagging supply.
All right. Well, we definitely appreciate your time and thanks. We hope you found it insightful and have some takeaways with you. Feel free to reach out to us at any time. And so with that, we'll pass it back to you. Jess, thank you.
No, thank you guys. This was a great discussion, and I have no doubt we could have continued talking for the rest of the afternoon about this topic. It will be interesting to see, how the markets change or what happens over the next 6 to 12 months. So I want to thank Brian and Jonathan for all the work they put into today's event, as well as the rest of the team at NG Impact. And at this point, we're going to conclude the webinar, and I hope everybody has a wonderful day, and we look forward to seeing you back on with us soon.